Welcome to GRE. I'm your host, Keith Weinhold, talking about safety and investing, all the other asset classes compared to real estate, then a chance for you to leverage my real estate contacts with an introduction right here on the show, today on Get Rich Education. Knowing the difference between a turnkey provider and a vertically integrated rental property company can cost you hundreds of thousands of dollars over the life of your investment. Some companies sell you a property they don't own, renovate it with contractors they don't control, refer you to a property management company they don't manage, all in multiple markets because they can't source enough inventory. That's why truly passive investors work with our friends at JWB Real Estate Capital, perhaps the country's only vertically integrated rental property investment company. They operate in one market, Jacksonville, Florida, and their whole job is to make investing in rental properties easy for you. In fact, because of their vertically integrated approach, their clients have gained 79% more home price appreciation than the overall Jacksonville market since 2013. Find out more about why it pays to invest with JWB. Call them at 904-677-6777 or go to jwbrealestate.com/GRE. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4 plexes. So start your pre-qualification and you can chat with President Chaley Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, your voice for real estate investing for almost 8 full years now. How's it going? I'm your host, Keith Weinhold. I'll tell you, safety is not my favorite word in investing. It's not expansionary, but safety is still worth discussion. In fact, maybe the most famous quote from the best-known investor, Warren Buffett, belongs here. You've surely heard it before. Buffett said, the first rule of an investment is don't lose money, and the second rule of an investment is don't forget the first rule. There, now that often cited quote has been cemented in this show's legacy, I want you to understand it's not a particularly resonant quote with me because it doesn't really have an abundance mentality behind it. So let's break it down because it still matters for sure. How safe are you in your investments today? So let's talk about many common investment types and how safe you are in each one of these if you're in them. Well, what if you've got green cash stuffed under your mattress? How safe is that? Well, it's susceptible to a low risk of overt theft by a robber and a high risk of stealthy theft by the government through inflation. Yes, the current CPI figure is 9.1%, but let's play it simple here and call it an even 10%. Well, with 100K stuffed under your mattress, you'll have 90K of purchasing power after just 1 year. Well, how safe was that then? And it's not much better if you instead put 100K into what they call a high yield savings account. Are they ever going to stop calling these things high yield when they're like a fraction of the rate of inflation that they pay you? Because it only yields about 1.5% today. That's according to NerdWallet. So that means your 100K saved would have $91,500 of purchasing power in a year because you need to deduct 10% inflation and then add back in a 1.5% interest rate. Okay, so there in that, call it an online high yield bank, it was safe from theft, but it eroded to inflation. Now, when you think about bank account safety, you might know that the FDIC insures your savings for up to $250,000. That's per depositor per insured bank. And by the way, that stands for the Federal Deposit Insurance Corporation. That means that if there's a run on the bank or the bank goes insolvent, the FDIC is supposed to jump in and reimburse you for what could be lost, only up to that amount, that $250K. And understand that that $250K limit, that's why only smaller investors would put money in a bank. The big money, like that institutions invest, that is in treasuries, because that $250K insured limit, well, that would hardly help the institution that has $100 million to park there. So rather than putting money in a bank where it's exposed to that risk, that's why the institution with $100 million to invest seeks safety. They put that 9-figure amount into treasuries because treasuries, they're backed by the US government, not the FDIC. So that's why that works that way. Now, what if you want better yield on your $100K investment and you're, say, willing to lose liquidity by locking it up in a 5-year CD, a certificate of deposit? That means that you can't touch it for 5 years. Well, the best rates now on those are somewhere around 3%. So if inflation's 10, then that's your 7% loss in purchasing power each year, plus you've got no liquidity, just some measure of safety in CDs. Here, in inflationary times, what about the all-time classic inflation hedge? It's one of the few goods that's had enduring value for 5,000 years, and also for every single year of the last 5,000 years. It's the store of value. It's what you can think of as money insurance in a sense. Yes, I'm talking about gold. Well, despite high inflation, gold has not risen. And then if it takes you as many dollars to buy gold today as it did 1 year ago, well, then gold has effectively lost 10% in purchasing power, just like the dollar has. But gold has more safety than most other asset classes. Most anyone would agree with that. Gold is not a wealth creation vehicle. It is a wealth storage vehicle. It's a preservation tool. What about cryptocurrencies, which I think should be more appropriately called crypto assets because it doesn't have that much acceptance as a currency? Most anyone would agree that they are high risk and low safety. Bitcoin, Ethereum, some of the others, the altcoins, many of these, many of them actually have less risk than they did a year ago, and that's because the price of them is so much lower today. Understand that Satoshi, Bitcoin's creator, he didn't invent Bitcoin saying, hey, here's Bitcoin, now everybody can go out and get rich. Satoshi said, here's a private peer-to-peer money that's decentralized and outside of government control. I'll tell you, I don't like crypto as much as I used to, and it's not just because we're in a crypto winter where the price is down so much. It's because with the implosion of these pseudo-crypto banks like Celsius, where I lost some Bitcoin, and Voyager, we learned that earning yield from your crypto, that is a riskier proposition than a lot of people have thought. So if you're trying to get yield on your crypto, a little cash flow, you're taking substantial risk by not having it on a cold wallet and foregoing that income stream. Even keeping it on Coinbase entails a loss in safety. We learned that there is a lot of leverage in the system. Cascading margin calls took down the price and took down some of these crypto lending platforms like Celsius. And despite all that, I still think that Bitcoin could have some redeeming qualities, like its immutability through its fixed supply of 21 million, like I've discussed here before. Crypto still has low safety, at least here in the near term. We're talking about safety in your investments today as I filter many popular investments through this safety screening, if you will. We're in times of high inflation, and stocks have historically moved in the opposite direction of inflation, and this is because the Fed is checking inflation and increasing interest rates to slow business and consumer spending. Well, this spending slowdown is exactly what hits corporate bottom lines, which in turn lowers stock prices. This is mega bad for stocks and their derivative products and mutual funds and ETFs. And a lot of people don't really think it through this way. If stocks lose 20%, well, you probably already understand that they then need to gain 25% just to get back to even. That's math. But what fewer people seem to think about is that if inflation is 10% and your stock loses 20%, Now you're down 30% in dollar strength terms, in your purchasing power terms. So now you've got to gain 43% back just to return to the same level of prosperity that you had before. Yeah, a 43% gain is needed, and even then, you wouldn't be ahead at all. That's the situation for a lot of stocks now. That volatility component of stock investing is just one reason why stocks only make insiders wealthy. All right, well, what about real estate then? How is its safety? As we know, in inflationary times, housing, food, and energy are three areas that perform well. Well, it depends on how you do real estate. Now, what if you bought some raw land and you paid all cash for it? You very well may, because it's more difficult to get loans for raw land. All right, well, how safe was that? How safe is what you just did there? I think it's fairly safe. Land values generally track inflation, and you're often not going to lose much money as long as you know what you're doing, although you're going to have to look out for some expenses. Raw land could still have a property tax obligation, and yet it often produces no income for you if it's just in a raw land state. Well then, how about buying a new primary residence with 20% down and an 80% loan? If you do that, how safe is that today? A home for you to live in? It's pretty safe in inflation. The asset value could track inflation, plus inflation debases your mortgage debt at the same time, but you're going to have a ton of expenses with it, like taxes and insurance and maintenance and repairs and maybe an HOA. You don't have a tenant to pay for those things, but you do have the benefit of living in it. Well, then in that case, you might think about safety differently. On a neighborhood basis, it might come down to something like a low crime rate where you live. Now, if you don't know what you're doing in real estate investing at all, and say you throw two darts. You throw the first dart at a dartboard of stocks that you've got to buy when the dart hits that stock on the board. And then the second one is where you throw a dart at a dartboard of properties, say in this weird game that you set up in your garage. Then I actually think that real estate could be less safe than stocks. Okay, that's to the completely uneducated investor throwing darts at a board. But you only have to learn a few simple things to make real estate fairly safe and safer than stocks, really limiting your downside. Once you learn about how your tenant income stream controls the mortgages, you can create leverage and that the market is more important than the property, just some little things like that, you're getting quite safe fast. And this is what turns investing on its head, because typically with high returns, you need to take on more risk. But with carefully bought real estate, you can see how 20 to 25% annual returns are common and even expected, all with pretty high safety. And on a national basis, even during the global financial crisis 15 years ago, which was an awful downturn with an unlikely confluence of so many bad circumstances, even then, real estate only went down a bit more than 20%, and then it bounced back. And with income property, that appreciation center went away for you. Say you had an income property during the global financial crisis. You've got the other for-profit centers while that appreciation went away. You still got your cash flow, your ROA, your tax benefits, and of course your inflation profiting on the debt. So therefore, income property during the GFC, the global financial crisis, that might have been a break even for you, or even just eking out a pretty small gain. I mean, talk about safety. The whole getting paid up to 5 ways, that's what provides ballast and safety to real estate. And this is all inside fairly passive investing. And you know, when the everyday American thinks about real estate investing, you just give them those 3 words and you ask, tell me your thoughts, tell me what you think. You know, they don't even think of it in this passive way. Most people think it's active investing. And what do I mean by that? The layperson on Main Street, they think that real estate investing means you either need to get your hands dirty by flipping it, or get your hands dirty and get involved by being a landlord, or even do both of those things. And now those activities, flipping and landlording, they're okay, but we're not talking about being the landlord or the flipper here very often, although we still do have a number of landlord tips. You might want to self-manage your property for a while in the beginning. Now, we're talking about properties that are either new build or renovated here on the show. And of course, they're filled with a tenant and under management. That's what people think of as turnkey real estate investing. Now, look, if you buy a house every year for 10 years this way, you can be on a financially free path with high safety. And say you think that you can only afford just exactly one house per year for each of the next 10 years. Now, if that's what you think, the good news is that you're probably going to be able to afford more than that. And that's largely because as your leverage equity builds from those early properties, from your early purchases over that 10-year time horizon, you're likely going to want to do a cash out refinance or an exchange and trade it up for more. That's why if you're thinking about 10 houses in 10 years, the reality is maybe you can really get to 20 or 30 houses or doors after 10 years. The layperson on Main Street, they also think that real estate investors get ahead because the tenant pays down your rental property for you on the loan side. Okay, so everyday people, they're just thinking about amortization schedules. Well, that helps, but no, most equity growth happens through appreciation when you made just a 20 or 25% down payment. Now, the everyday guy or woman on Main Street also may not realize what you do. In inflationary times, people need two jobs in order to be safe. There's that safety word again. To be safe from inflation, now you have two jobs in high inflation. Your first job is your day job. That day job pays you in dollars. And then your second job is to get out of that dollar before it's inflated away. And it's really only in this last year plus that the Main Street layperson has seen inflation that's noticeable. That's really a key word here. When a problem is noticeable, that's the only time that one's behavior changes. Now, a few years ago, when inflation was just 1.5%, it wasn't noticeable. That means that people were more content to store dollars in a savings account, and why that same scenario is unsafe today. And when we talk about what is noticeable, perceptible, and discernible to the everyday person, let's listen to a recent clip about how major media covers inflation, about how they're informing the public. And this is about as mainstream as it gets. Here's a 2-minute clip of the NBC Nightly News with Lester Holt through NBC reporter Tom Costello.
For anyone struggling with daily expenses, especially seniors on fixed incomes, today's inflation report is not just an economic stat. It's very real. The highest inflation in 41 years. In Delray Beach, Florida, the cost of electricity to keep the AC on is crushing 66-year-old Veronica Bolig. She just received last month's bill, but she's already a month behind.
The total bill was $592.11 for 2 months.
$592. Veronica has a disability and is raising a granddaughter after her own son's untimely death.
My Social Security is not getting any higher, but my bills are getting higher and higher.
Too high.
I didn't mean to do this.
Veronica, among the tens of millions of Americans struggling with ballooning prices for just about everything. The cost of housing, shelter up 5.5% in 1 year. Electricity up 13.5%. Natural gas up almost 40%. Breakfast, lunch, and dinner is more expensive. Food up 10.5%. But this is where inflation is really biting. Gasoline in June cost nearly 60% more than a year ago. Oil up almost 100%. In Maryland, Alex Nielsen runs a landscaping business with 45 employees. He says this summer he's spending $3,000 more each week for fuel and oil.
You've gone from $1,000 a week in fuel cost to $4,000? Yeah, the price of mix of oil, bar and chainsaw oil, 50-50 mix for the weed whackers and the blowers have all gone up. The price of diesel, everything's gone up.
Now forced to pass a fuel surcharge onto his customers. There is some good news. Gas prices have now dropped 38 cents in a month. The hope? Inflation may have peaked in June.
There is no question that we still have work to do.
The Fed is going to say, oh, my goodness, we've got to stop this snowball from getting bigger and bigger and turning into an avalanche.
Now, the mainstream media, which I do like to keep up on a little bit because it informs me on how most people think, which is important for you to know. Oftentimes the mainstream media, they don't tell you what to do about an economic affliction like inflation, and that could be okay. I think the news's job is to inform you more so than educate you. We are educating you here. If the mainstream media does give you some tips for how to deal with inflation, well, it often steers you into reducing your standard of living, like driving your car less or something like that. Well, this is where I come in. Income property means that inflation enriches you. You can't stop inflation on your own. I can't stop inflation on my own. If you get your whole real estate investor meetup group together to conspire against inflation, that's not going to help either. So we're learning about what you can actually do about it with relative safety while profiting. That's what we're doing next in an actionable way. It's your opportunity to leverage my industry contact straight ahead. I'm Keith Weinhold. You're listening to episode 408 of Get Rich Education. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant-resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner Nolasco and team also invest strongly in their own product. That's belief. Start at build2rentdirect.com. That's build2rentdirect.com. Or text 407-927-5074. Hey, my friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. If you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damian and the EQRP company can fix this. Those IRAs can be converted into EQRPs retroactive to last year, getting those tax deductions and reducing your taxable income. In this way, you can invest your 401k or IRA in real estate, Bitcoin, gold, and even your own business. So whether you're a full-time investor or retired or even a dentist with dozens of employees, if you're listening, you qualify, the EQRP works. It's a solution. You'll control your money, kill UBIT, and pay way less taxes. To learn more about this strategy and free up your retirement money, get the newest EQRP special report. Text GRE to 307-213-3475. That's text GRE to 307-213-3475.
Hi, this is Russell Gray, co-host of the Real Estate Guys radio show, and you're listening to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Hey, well, I'd like to welcome in Wagner here. You're hearing from one of our providers, really the voice of GRE Marketplace Orlando. How's it going?
Hey, Keith, thank you so much for having me.
I always like having your energy on the show. Hey, go ahead and give us an update overall, whether that's statewide Florida or Central Florida with the market update.
That's a great question. So, well, Central Florida overall, the state of Florida is doing great. We have a very, very strong governor that took a lot of great actions during COVID, and the state has been growing tremendously. And that actually reflects into the employment rate. The Business Journal just actually came out today with an updated number, and we're now number 5 in the country, hosting a 7% on job growth in the past 12 months. So a lot of jobs are coming here. That's why real estate makes sense in Florida, because if you don't have jobs, you can't pay your rent. We were actually elected as well by the New York Times as 4 of the best places to invest due to house shortages. So Palm Bay is one of them, Ocala is one of them, Palm Coast is one of them. So what does that mean? It means we have more demand for inventory than available units. So, for example, Palm Bay, we're 3.7% on a deficit for existing inventory today, which is huge. So we are actually out of the list of 10 cities that are in deficit of inventory. Florida has 4 on top of that list. So we're doing really well. A lot of demand, but very little supply.
Demand exceeds supply in many U.S. places. That's certainly no exception in Florida. The national housing crisis, that's something that's pretty well documented. Wagner, the entry-level home market is especially underserved. If you go ahead and section out just where we have this paltry amount of supply within the housing market, it's sort of those homes that make the best ones for first-time home buyers or for single-family rentals. I mean, the entry-level supply is lower than Death Valley amidst the overall supply that's screamingly low. Before we talk more about those sorts of things and dynamics in the market, when I think about Florida, I think about a state where a lot of insurance premiums have really increased, even greater than the rate of inflation. Can you tell us more about the climate with Florida insurance premiums?
So you're absolutely right. Insurance has been a problem in Florida lately, Keith. Some of the companies are evading the state because they had so much claims against their policies that they're leaving the states. So as you know, Keith, we now have an in-house insurance company that we provide insurance. We're actually affiliated with American Integrity, which is one of the largest companies that issue policies in the state of Florida. So what can I tell you, Keith? On a 2022 build, new construction property, you're probably going to be paying about 67 to 75% less on your premium than a used home. And why? People don't know that every property that has been built 3 or more years ago, they're not complying with the building codes. What do you have to do to qualify for a premium? You have to do a 4-point inspection and a wind mitigation report, meaning you have to hire a professional to come to your house to issue a report, making sure your roof is actually in good condition, it withstands. So premiums in Florida, if you're looking at whole homes, flips, not a good thing to do. You're probably going to be on the thousands of dollars on premium. That's why we only build new. I closed 2 houses, Keith, in Ocala about 2 weeks ago. My annual premium for insurance on each one of those houses, including hurricane, is $314 a year.
That's incredibly low. Yeah, where I'm personally seeing increases, properties that I own in Florida are specifically in those older renovated properties, not the new builds.
Correct. So my advice to you, as I have done a lot of renovated properties, I own them, and I only own new builds today, is insurance is probably 75% more expensive on an existing property than a new construction, just because they don't comply to all the building codes that are now up to date. And insurance companies are never going to lose. They're not going to take the risk. They're not going to pay a premium that they're going to lose money overall. So my advice to you is just look carefully on what you buy. And if you decide to do your due diligence, make sure you do a 4-point inspection and a wind mitigation report and have several codes before you close on the property, because the insurance sometimes can be almost as high as your mortgage.
Now, we talked about new builds, and when you think of the phrase new builds and you're in the income property world, that is the build to rent space. Tell us more about what you're doing in the build to rent space today.
Keith, as everybody knows, inflation's at 9.1%. You know, the euro just became 15% less than the dollar is worth. So, you know, things are changing. And with that in mind, we wanted to bring peace of mind to investors. And we have seen that there's a lot of equity that still are built in on today's market on the entry-level homes that we built. So we created a product thinking about the investor only. So on a new construction, Keith, we're very conservative. We make about 12% on a new build as a builder. And we're going to be passing along all the savings, all the money on the equity to the investor. For example, we're building a brand new 4-bedroom, 2-bathroom, 2-car garage concrete block in Palm Bay for $319,000. No escalation clause. Correct. You heard that. No escalation clause. Once you lock in your contract, that's how much you're going to pay at closing. No more surprises. We will absorb all the material increases from now until your house is delivered.
Okay, in order to back up for a moment, just in case a listener doesn't understand what an escalation clause is, that means that a buyer has to pay more for the home by closing time than that original accepted price up front. And that's what we're learning does not exist here with these properties. No escalation clause.
Correct. The price that you sign the contract is how much you're going to pay at closing. And we're going to help you in every step of the way to secure that construction is actually fast. You do so. The steps are very simple. They're very simple. We will actually buy a lot under your personal name. So you have security that anything that goes on top of that land is yours. We'll help you if you're willing to get a construction loan. If not, we'll actually help you to actually do installment payments and up to 4 installments for the whole construction time. Now, how much are those houses appraising and selling today? Well, as you know, we love to sell properties that have built-in equity, positive cash flow, and appreciation. Appreciation, nobody can guarantee, but all the positive cash flow and the built equity are there in day one. So the house that you're paying $319 is actually being sold and appraised on the market today for over $370,000. I would love to send you comps on the houses, and we'll sell it to you for $319. Are you that good? Keith, I'll tell you what, I want investors to buy 1, 2, 3, 10 properties because that's what we do. One of the largest mortgage suppliers for investors in the country was here a couple of weeks ago with me, and he ended up buying 3 new constructions, just as we're talking about.
I know who that person is, too. And yes. So, okay, a $320K purchase price for these 4-bed, 2-bath new builds that you just described. That price is now about 25% lower than the national median, which is funny because that sounded like an aggressive price point for an income property just a few years ago. But today, of course, it's not. So that built-in equity is appealing. This has a market value of $370K at this time. You talked about how one buys the land and has the land in their name until that property is constructed. So explain that some more. Do they have the option of either paying all cash, $320K at once, or is it making those installment payments over time? Or talk to us about the financing and how does that look?
Actually, they can pay cash. They don't have to have all the cash day one. We'll actually have them pay it in 4 installments that we progress with the build. All the money stays with the client, which is really, really important. I don't want anybody's money before we actually need it, right? So if it's your money, keep it in your bank account until we actually need it for the construction. So 4 installments is one option if you want to build cash. And let me just say that this can actually be utilized for 1031 exchanges. So if you have a 1031 exchange that you are in need to qualify and identify a property, we'll be able to help you with that. Let us know and we can qualify for 1031 exchanges. The second option, Keith, we will help you through banks that we currently have to get a construction loan. Okay. So construction loans are usually only utilized for the building period of the construction of your property. We will actually help you qualify as well for a perm loan, which is a 30-year fix and interest only, whatever you guys prefer.
The permanent loan after the construction loan is done. Some people think of that as a purchase loan.
Correct. It can be a purchase loan. It can be a refi. It depends how we structure your purchase. And if you prepaid cash, it's going to be a cash out refi in some cases. Or we can actually structure in a way that you're going to be getting a brand new mortgage for a new purchase at the time of closing.
Okay, so if one isn't going to pay all cash, they could potentially get that construction loan, hold on to that construction loan during the construction process, and then transition that construction loan into a purchase loan at the time of closing.
Correct. It's actually an all-in loan. If we wanted to utilize a construction loan to perm loan, it's all one loan you apply one time. And we're going to be building your house. Once that house is built, it converts into a long-term loan, a 30-year fix usually.
What's the loan-to-value ratio on the construction loan?
You need to have 25% down, which the land actually qualifies as part of that. And the bank will give you about 75%.
I'm looking at a downside here of it takes a patient dollar. Once you've invested, it's going to take some period of time. And then the upside is that you have a new build property with expected built-in equity because there's no escalation clause from the time that you come in on that agreed upon $319K purchase price.
Absolutely, Keith. And let me just give you a little bit of flavor as time goes by. So we start building this model home in the same location about 4 years ago. 4 years ago, I was selling this house for $139,000. Then the price went to $205,000, then $225,000. Then now you're paying $319,000, but the houses are retailing for $370,000. So as I had mentioned at the beginning of the show, the New York Times had issued a city list of the most desirable and demanded inventories in the country, and Palm Bay is definitely one of them.
So help us see these new build 4-bed, 2-bath properties that are entry-level homes and are conducive to renters renting them out, and then the owner holds on to it for the production of long-term cash flow. Are we talking about infill lots in suburban areas in proximity to the ocean and so on?
Absolutely. They are west of I-95, so, they're not going to be exposed to the elements as much, but they are infill lots. Usually your land is going to be based on a quarter of an acre, which is 10,000 square feet, which is a large lot, actually. And the house is going to be a 2-car garage, concrete block, vinyl flooring, granite countertops, LED lighting. We're going to have tile in the showers. We're going to have a tub on the secondary bathroom. I have videos of the house, pictures, would love to actually show it to you guys. And if the opportunity presents itself, why don't we actually, Keith, do a tour? We can organize a tour of your listeners and your investors to come have a meal, understand the area. You can visit Port Canaveral. You can visit all the amenities of Cape Canaveral. SpaceX is there. A lot of technology companies, space companies are there now. A lot of engineers, which is tenant base that we love. Engineers is what we love. A lot of public traded companies are there, as well as a lot of defense companies. NASA is there. Blue Origin is there. Lockheed Martin is there. I mean, there's so many great employers that need inventory for their engineers that are coming to work from California, New York, New Jersey, Connecticut. So inventory is at a very, very high demand at this time.
Yeah, well, thank you for that invitation. And if you, the listener, want to learn more and get started with this particular group of properties that we're talking about in the Palm Bay, Florida area, you can do that at gremarketplace.com/Orlando. At that page, we're not typically talking about Orlando proper. We're talking about more outlying areas in Central Florida that ring outwardly from Orlando. Again, that's at gremarketplace.com/Orlando. Really, the buyer, once they do close after the property's built, they're interested in having a pretty low hassle, low friction experience. And with the vertical integration that you have at your company there, oftentimes investor thinks about the tenant placement. Tell us about that tenant placement experience, especially now that you have more of a track record. How long is that first tenant typically staying in a new build property like this before they vacate? I bet they really like it. I bet it's really difficult for them to find anything better than that unless they want to buy, and it's harder than ever to buy with higher prices and higher rates.
You just hit the nail right in the head. I mean, the property is no good unless you have a tenant, and it's a great tenant that pays its rent on time. And usually our tenant retention is they stay in the same property for about 3 to 4 years, right? So as you know, capital expenditure can really affect your cash flow. So the longer a tenant stays in a house, the less turnover, the less expenses you're going to have on that property. So 3 to 4 years, usually it's what we have. On our property management company that it's in-house, we have 100% occupancy on all of our houses. Today, we have 0% vacancy and 100% positive collection on rent. So pre-qualifying those tenants, identifying the best tenant for your property is a key. A property management company can make it or break your investment. So we will handle that in-house as well, Keith. So once you purchase the house, we built the house, we will rent the house for you. In 2022, if you buy a house from us at the GRE marketplace, we will actually give you the credit at closing for a 1-year insurance policy for your house. We just cover some of the insurance. If you buy this house from GRE exclusively, only from GRE, we're going to give you 1 year free insurance for the house. That's going to be credit towards your closing.
Beautifully done. Yeah. Like Wagner and I mentioned, we have a mutual friend that just bought 3 of these properties in Palm Bay, these same ones that we're discussing today. And basically, I wanted to have this chat to learn more about them myself. Is there any last thing that today's investor in Central Florida or these new build to rent properties in particular should know?
The last thing I wanted to leave for the investors is this. This is the biggest leverage against inflation. We're going through very high inflations. Do not leave your money sitting in the bank, depreciating. The fiat currencies are not going to be worth anymore soon. So invest in something that is an appreciating real asset that you can touch, tangible. Look for the jobs. Follow the U-Haul trucks. Florida is booming. We have a lot of jobs. People are coming in. They're buying properties because they're actually underpriced. And because you have built-in equity day one, if the market adjusts in the future, you have over $50,000 worth of equity that you can adjust. Actually, we haven't seen depreciating asset in real estate in Florida since 2008, But, if something happens in the market, you're pretty much guaranteed because we're not keeping the equity. You are, and you're keeping the property for generational wealth, for cash flow, for retirement purposes, whatever your goal may be. This is the conduit. This is the vehicle that is going to give that to you. Real estate is the only way, in my personal opinion, that is going to help you achieve financial freedom.
As I like to say, real estate, it's really more than an inflation hedge. It's an inflation profiting center when you benefit three ways at the same time, like you do with leveraged income producing real estate. It's funny, we used to go into great detail on the show here a few years ago about all the in-migration to Florida, but that's not even a detailed topic anymore because just everyone knows. So let's start talking about team and the properties. Thanks so much for sharing that with us. Again, if you want to learn more, get started at gremarketplace.com/Orlando. It's been great having you back on the show.
Thank you so much, Keith. Thank you, everybody. Take action. Do something. Make it happen.
Oh yeah, good, specific, actionable content there. Palm Bay is southeast of Orlando, near Florida's east coast, but these properties are typically not too close to the shore. It's good to hear from our affable guest. He's been with us here annually or more often than that for 3 to 4 years now. When it comes to something like a 4-bedroom rental property that we're talking about here, what are the trade-offs with having a property with, say, fewer bedrooms? Well, 4 bedrooms in an older renovated property, that can increase your maintenance costs over time, having that extra bedroom or two, without providing that much more in rent. Now, an advantage of 4-bedroom properties is that you tend to get a larger family that's more likely to stay there longer. 4 bedrooms can work well with new build rental property like this because with new builds, your major maintenance costs often don't occur for more than 7 to 10 years. And since you're conscious of leverage ratios for your rate of return, meaning that you don't have this hold it for 30 years and pay it off mentality, well then after 7 to 10 years, there's a good chance that you're going to trade up this property for perhaps 2 new build properties down the road. That's why 4-bedroom new builds really work for those that think like an investor. It's not easy to find a source for available entry-level new build homes built specifically for renters and investors like this. Is there any way really that you think you'd be worse off owning a few new build rental single-family homes in Florida with all the demographic, inflation, and supply trends lining up like this over the long term? You're probably not worse off. It's hard to see how this could be a bad move, and supply is limited because, well, entry-level housing supply is limited in nearly every American place that has a growing population today. So it's great to bring you something specific and actionable here. Again, you can get started at gremarketplace.com/Orlando. I'll see you next week. I'm Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.